Hi, I'm George Baxter. I'm here to talk about your retirement. As you can see, I've already reached that age and I have been through what I'm about to show you. So I want to help you learn the difference between a Roth IRA and a traditional IRA. Choose for yourself which one is better. I think it'll be obvious, at least to me, which one is better. I define better by which puts more money in my pocket. And that's what I did when I'm presented with two alternative possibilities. I'm a numbers guy, and I just apply the numbers to each situation because the numbers don't lie and the numbers don't have an agenda, and they will tell me which direction to go. And I think you'll see that in this presentation. One thing I want to say when I start, I have done a lot of work with homeless people, and old and poor is a horrible combination. And old, sick, and poor is the worst combination. If you want to see what your future looks like if you're going to be old and poor, I suggest you go to a homeless shelter some weekend, help pass out some clothes or dish out some food, and talk to some older people and ask them what it's like to be old and poor. You won't see a lot of smiling faces. When I had my first business, I had an elderly gentleman there, and I told him that my father passed away 3 months into my 12th year. So I didn't get a lot of advice from older people. And I asked him, give me a piece of advice. And with tears in his eyes, he said, save your money. I wish I had the money that I blew when I was young. Now that I'm old and I really need it. And one of the best ways for you to prepare for your retirement is to commit to an IRA for the full duration until you've stopped working. And that's what we're going to talk about. First, I want to talk a little bit about Social Security. You will get Social Security. Don't worry about that. It started in 1935, and by law, it was to be tax-free when you took it out. Well, 49 years later, somebody in Washington, D.C. decided we kind of have a revenue shortfall here, and there's a lot of money going out in Social Security payments. Why don't we start taxing that? So they thought, well, that's a good idea. We'll tax up to 50% of what people are getting in Social Security over a certain income limit. And it reminded me of Darth Vader in Star Wars when he said, I'm altering our deal. Pray I don't alter it further. Well, guess what? In 1993, they altered it further and raised it to 84% of what you get in Social Security that could be taxed by our friends in Washington, D.C. Do you think that can't possibly happen to a Roth IRA? For those of you who are unfamiliar, a traditional IRA, up here, you get a tax deduction when you contribute to it. You pay taxes when you take it out, or you report it when you take it out. The Roth IRA, you pay the tax up front, and for now, it's tax-free when you take it out. Unless our friends in Washington, D.C., 20 years from now decide we have another revenue shortfall, let's start taxing Roth IRAs. Could happen, it's happened before. All right, when traditional IRAs started, you were allowed to contribute $2,000. That's not going to provide for much of a retirement, so they've raised it now to $7,000 a year, $8,000 if you're over 50. Well, along about 1997, Senator William Roth from Delaware decided, let's make the American worker a deal. Let's tell them if they pay tax on that money that they contribute to their IRA up front, they can take it out tax-free when they retire. Sound familiar? Well, what they don't tell you is if you're contributing to Roth IRAs for 40 years, assuming you're working for 40 years, you're going to pay $60,000 in taxes before you ever take out one dime from your Roth IRA. If that sounds like a good deal, it's a good deal for Washington, D.C. It's not a good deal for me. I don't like it. And if you ask me, I'd rather pay taxes in 40 years than pay them today. Okay, we're going to use a chart here because it makes things quite simpler. It's called a future value chart. There are also present value charts. If you don't know what those are, just Google them. They're pretty simple. Pretty much tell you if you put a certain amount of money away for a certain amount of years at a fixed interest rate, what you will have at the end of those years, the total. It just gives you the number and you multiply by it. So first we're going to make a few assumptions. Okay, we're going to assume you're in a 25% tax bracket overall. Federal, state, local, you're paying 25% taxes. If you make $100,000, you're paying 25 in taxes, you're taking home 75. We're also going to assume that you've got $6,000 a year to work with for your retirement. You can either put it in a traditional IRA or a Roth IRA. And if we go to the future value table, and we'll bring that video or that picture up for you. You go across the top to 8% because that's the return you're going to assume we get. We'll explain that in a minute. You go down the table to the bottom, which is 40 years, you get a number 259.0565. That's what we multiply $6,000 a year from or with to get what you will have in 40 years. Now I'm using the 8% return because a lot of pundits say the stock market goes up 8% every year on average over time. What they really mean is certain indexes go up 8% a year over time for a certain number of years on average. So they're talking the Dow, they're talking the S&P 500. What they're not telling you is, first of all, the Dow is only 30 stocks, and there are thousands of stocks in the stock market. The S&P 500 is the top 500 companies, and there are thousands of companies other than those 500. And the thing they aren't telling you is they change the stocks that are in those indexes. They drop out the losers and they replace them with winners. So it creates the facade of a market that goes up 8% regularly, but that's by changing the companies that are in it. For instance, Goodyear Tire used to be in the Dow. So did Sears, Kodak, AT&T, Bethlehem Steel, Woolworths. How many people remember Woolworths? American Can, International Harvester, which became Navistar. I wonder what the Dow Jones Industrial Average would be today if these companies were still in that index. It's been replaced with companies like NVIDIA, Apple, United Healthcare, McDonald's, Walmart, Verizon, Home Depot, and Microsoft. They drop out the losers, losing stocks. There's not necessarily losing companies. They're generally just old, mature companies, and their stocks can't go up much anymore because it's a lot harder to double from 10 billion to 20 billion than it is from 1 billion to 2 billion, and your stock can double very quickly at that state. All right, now we get to the point of, is it taxable? I am retired, and I am taking money out of my traditional IRAs. Whenever I call my custodian, that's the company that handles your IRA funds, they say, it's taxable, you're going to have to pay tax on it. I said, well, that's not necessarily true. Why not? Well, the reason is we have standard deductions. Now, we'll go through this. I'm married, so we file filing jointly. If you're single, you're just going to have to divide it in half. And these numbers will change a little bit for everybody, but these are ours for this year. We're married filing jointly. We can take a standard deduction of $31,500. Social Security, they are trying to get back to not taxing it. So this year they're giving us a $6,000 credit for each person on our Social Security income. So that comes to $12,000. If you're over 65, you can take another $1,600 deduction. So that's $3,200. And they brought back the charity deduction for people who take the standard deduction. It used to be you had to itemize to take your charity deduction, but they decided people who take a standard deduction should be allowed to give to charity and get a deduction for it. So they gave us back $1,000 a piece. That's $2,000. So total, $48,700 in standard deductions. That's $48,700 I can take out of my traditional IRA if I have no other income or my income is non-taxable or very low. I can take $48,700 out tax-free, just like a Roth, but I didn't have to pay $1,500 a year. We'll go over that in a minute. $60,000 for the right to take out tax-free when I retired. So here's the story. If you take your $6,000 and put it in your traditional IRA and you multiply it by our number 259.0565, at the end of 40 years, you will have $1,554,339. If you do a Roth and you've got $6,000 to play with, you can put $4,500 into your IRA and pay $1,500 to the tax department. Multiply that by the 259 and you'll get $1,165,754 when you retire. A difference of $388,585. $388,000 more dollars in your traditional IRA than in your Roth IRA. And for the privilege of sacrificing $388,000, you paid the government $60,000 in taxes over 40 years. If that sounds like a good deal to you, it's a good deal for Washington, D.C. It's not a good deal for me. So you pay $60,000 in taxes up front. You get $388,000 less because that's how much you would have gotten at 8% interest on that $60,000 over 40 years. You gave that up, as well as you gave up $60,000 to the tax man. That doesn't sound like a good deal to me. All right, so now, when you reach age 73 now, and I think in a few years that's going to be raised to 75, you are required by law to take money out of your traditional IRA. So you start reporting it on your taxes. You have to at that age. All right, so the minimum distribution, and this changes a little bit. They give you the number of 4%, and it might be 3.8, it might be 4.9, but it's going to change a little bit. We'll just take that as an average. All right, so at 73, let me move over here for you. My minimum distribution of 4%, if I have $1,554,000 at 4%, that's $62,173 I have to take out of my taxable IRA. And I have to report that on my income tax. But I've got a deduction of $48,700, so my taxable income, if I do nothing else, is $13,473. That gives me a tax of $1,348, or 2.16% of $62,000, which isn't really too steep a bill to pay. Yeah, here we go, $1,348, as opposed to paying $60,000 up front and sacrificing $388,000 on the other end. I don't mind paying $1,348 in that situation. I'd rather have the extra $388,000. And if you take that $388,000 and you divide it by the $1,348, if I had to pay that every year that I took a distribution out of my traditional IRA, it'd take 288 years to hit $388,000. I don't think I'm going to live another 288 years past age 73. I think it's a much better deal to go with the traditional. Okay, one more thing. As you take money out of your traditional IRA, this $62,000, let's assume it's an average of $60,000, for the first 6 years. You take $60,000 out for 6 years, you will take out $360,000. That lowers your balance to $1,194,000. If you multiply that by 4%, you come up with $47,773 you've got to report as income. That's below the standard deduction today of $48,700. So after 6 years, you're probably not going to take out enough money to pay tax on it anyway. Suppose you're wealthy enough to contribute $77,000 a year instead of $6,000. You'll come up with $1,813,000 in 40 years. You would have to put in $5,250 in your Roth, which would only give you $1,360,000. The difference there is $453,000 extra dollars in your traditional IRA. I'd rather have the extra money. There are times when the Roth IRA is a very good deal. Those times are when you are in a 0% tax bracket or a very extremely low tax bracket. For instance, if you're a student and you're working summer jobs, working after school, working on the weekends, maybe you make $10,000 in a year, go ahead and contribute to your Roth IRA because you're not paying any tax up front. You're not paying the $1,500. You're not paying anything because you're in a 0 tax bracket. When I retired, I was able to choose when I wanted to retire. You don't want to retire late in the year, November or December. If you retire, say, February or March, work into the next year and make a fourth of what you normally make, if that. Say you make $20,000 in 2 months. Then you'll be in a 0% tax bracket because you only made $20,000. You can go ahead and contribute it all to a Roth IRA. As long as you're not paying that tax up front, the Roth IRA is the way to go. No question about it. But I hear pundits all the time say, contribute to a Roth, it's tax-free when you take it out, contribute to a Roth. And they're not crunching the numbers. $388,000 is a whole lot of wiggle room. And I personally would rather have that extra money. If you are going to be in that low tax bracket, I recommend you go to your employer, tell them you want a W-4 form. The W-4 form simply tells the IRS, I'm in a 0% tax bracket. I don't want any taxes withheld from my paycheck. It's perfectly legal. You can do it. That way, the money comes to you immediately with every paycheck instead of having to wait till you file your taxes the next year and get your refund or whatever. And you can take that money and contribute it to your IRA immediately instead of waiting 12 or 15 months. Okay, I've probably ran on a little longer than I intended. I want to mention a couple of other things. It says, remember that the longer you can live beneath your means in your youth, the longer you'll be able to live above your means in your retirement years. And that's extremely important to grasp. You don't have to buy anything and everything that the Joneses have. You are the only one who's going to prepare for your retirement years. And like I say, old and poor is absolutely miserable. It reminds me of the Amish farmer who found out that the farm next to him had been sold. So he loaded up his horse and buggy and took some baked goods with him and went to meet his new neighbor. And they spent the afternoon together and had a good time. And when he was leaving, he said to his new neighbor, he said, now, remember, if you need something, tell me, and I'll tell you how you can live without it. And that's extremely good advice. If you remember the number we multiply by here, the 259.0565, that doesn't just apply to your savings account or your IRAs or any other investments. It also applies to your spending. If you spend $1 a year on candy bar, soft drink, cookie, whatever you can get for $1 in 35 years, over 40 years, That's not $40. That's $259 you took out of your retirement. Now, I'm not saying don't spend a dollar here and there, but I want you to think about when I'm young and I'm spending money, I'm taking this kind of money out of my retirement. And if you have to have a latte and pay $6, and you buy one latte a year for $6 for 40 years, you're going to take $1,554 out of your retirement. And that's just one latte a year. I'm not saying don't do it. I just want you to be aware of what spending in your youth takes from your retirement. And old and poor is horrible. It really is. I can't sugarcoat it in any way. Somebody somewhere along the line said, you're rich in proportion to the number of things you can afford to live without. And the Amish farmer knows that. And believe me, don't ever go into debt if you don't have to. Borrowing money to buy something makes everything more expensive. And why spend money that you don't have to buy things you don't need to impress people you don't like? I personally go by the philosophy, if I can't afford to save and buy it, I certainly can't afford to borrow and buy it, because borrowing makes everything more expensive. Well, I hope you've gotten something out of this little discussion. I hope somebody out there will save $388,000 by the end of their working years, and will remember some old guy on a video said to do it this way, and I'm sure glad I listened to him. Well, another thing that's very nice about the traditional IRA is that they allow you to make charity deductions without paying tax. If you're custodian, that's the company that's holding your IRA, Fidelity, Vanguard, Chase Bank, whatever. If your custodian takes the money, you'll fill out a form, takes the money and sends it to whatever charity you wish to give that money to, and you don't touch it, it goes directly from custodian to charity, then you can report on line 4A of your 1040 that you took out, say, $5,000 and donated it to charity, and on line 4B it'll say taxable amount and it'll be zero. The nice thing about that, other than the fact that you can give to charity without reporting it as income on your income tax, is that it also applies to your required minimum distribution. If you have to take a required minimum distribution of $60,000 a year, and you're a giver and you want to give $10,000, it'll come off that required minimum distribution. So instead of having to pay or report $13,473 on your as taxable income, you'll only have to report $3,473 because you donated $10,000 and you don't have to pay any tax on it. That is a big benefit to the traditional IRA. You folks have a blessed life. Thank you very much.